Hi everyone, welcome to FSM1 webinar where we help investors invest globally and profitably. My name is Harriet, Client Investment Specialist from FSM1, and I will be the MC for tonight. The Nomura Global Sharia Semiconductor Equity Funds offer a unique chance to tap into the booming semiconductor industry. We have the privilege of hosting Mr. Takeshi Kawamoto, the Senior Equity Analyst at Nomura Asset Management UK, on the topic of how the fund invests in a portfolio of companies at the forefront of chip manufacturing and capital equipment to capitalize from the ever-growing demand for these critical components. Mr. Takeshi joined Nomura Asset Management in 1987 and has been involved in global equities for his entire career. He is currently the global IT and telecom analyst at their London office. He graduated from Georgetown University in 1987 in business administration, double majoring in finance and international management. He is a chartered finance analyst, CFA, and a certified member analyst of the Securities Analyst Association of Japan, CMA. So stay with us until the end of this interesting webinar as we have the exciting perks going on. Now, without further ado, let us welcome Mr. Takeshi.
Thank you, Harriet, and thank you everyone for joining me today. Let me share my slides, and hopefully everyone can see my slides and hear me okay. And so I will expand. Great. So thank you for joining. My name is Tak, and I'm the IT and telecom analyst at our London office. The London office and the KL office investment teams are effectively one team. And so I've been working with the portfolio managers in KL for many, many years, even before this fund launched. And you know they place the trades. It's a Malaysian-based fund, but I'm the key decision maker, and therefore I've the privilege to present to you today on a fund that we launched. Oh, it's about 2 years ago, and it's been very, very successful. And I'll go through kind of our fund's philosophy and how we think about the industry. Um, First, I wanted to start from a very high level, though, and go through some of the history of the industry. As you can see on the left, is a picture of the first transistor, and notice how big it is. This is why when they made the first computers, it filled the entire room, because these transistors had to be hooked up with cables, and that picture is just one transistor in 1947. And in 1958, the first integrated circuit in the middle. And what an integrated circuit is it combines many transistors and other functions of the chip. And the first one was made in 1958. And then on the right is the more typical chip that you see today, billions of transistors on a chip. So we've come a long way in a relatively short period of time. And the driver of advancing so rapidly and greatly is Moore's law. Moore's law was a prediction made by one of the founders of Intel, Mr. Gordon Moore, and he predicted that the number of transistors would increase on a fixed square inch area every 2 years. And so the transistor density, this enabling more and more transistors to be packed together. And you could see the graph on the left that his prediction is pretty much played out, and we've marched along, doubling the number of transistors every 2 years, and that has led to more powerful laptops and smartphones, and faster, more performant devices, all while being more power efficient and cheaper. And so you could see on the right the cost per transistor has been coming down dramatically, and this has led to really cheap, very productive tools, and improved our standard of life, to be honest. In terms of how we're looking at the sector, The market likes very round numbers. So we think that the market, or the consensus, thinks that the market will be $1 trillion by 2020, by 2030. Um, but to be honest, this estimate is really too low because this estimate was the consensus before NVIDIA came onto the scene and introduced their AI chips, which is actually incremental to the market, and I'll explain why. Um, but even if you take the $1 trillion forecast, um, you know, the compounded annual growth rate through the rest of this decade will be high single digits, 10% high single digits, and that's very good growth. Much better than, let's say, global GDP. So we like investing in these high growth industries. We think the share price performance does very well. And a question I get asked many times when I do go visit KL, and I was in Malaysia last month. But the question that always comes up is, how much longer do we have? The share prices have gone up a lot, and how much longer? When should I sell? Can I still buy? And that sort of question is very common. And so in this table or this chart, what I'm showing here is the red dots. The small red dots is the peak of semiconductor unit sales, not revenue, but the actual number of units of semiconductors sold on an absolute basis. And the red dot is the peak for each cycle. Okay, and you can see on the table on the left that the average, period from peak to peak is 40 months. And the peak this cycle, we had a very bad year in 2023, as you can see, but the peak of this cycle was March of 2022. And so if you count 40 months from March 2022, it's the second half of 2025. So, just from that very crude analysis, you know, we still have room to much further more time before we hit the peak of the next cycle. And the red dots that kind of continue, that would be the peaks, and then after the next peak in second half 2025, there'll be another peak, 2028. So my main message is to distributors and investors that I've been meeting with is, don't really worry about, the ups and downs, right? Think, the red dots keep going, the high, each red dot is higher than the previous red dot. And, I guess the regression line shows that it's a very high growth industry. So that's really what you should focus on, not worrying about if it's too late to get in or should I sell or that sort of thing. In 2023, the industry was down 8.2% in revenues. And in this year, the market is expected to be up 16% in revenues. And for 2025, it's expected to be up 12.5. So and this is from the Semiconductor Industry Association forecast. And so, the industry is forecasting, the industry growth to be very good for the next 2 years. And on this chart here, what I did was I took the red dots from the previous chart, and then I plotted it with stock prices, share prices. And this is using the Philadelphia Semiconductor Index. And this is a logarithmic chart, but you can see that pretty much the peak of the sales of units coincide with, the peak of share prices, which makes sense, right? Fundamentally, it should peak near the peak of the unit sales. And so, there is a correlation. I just wanted to show that yes, we've had a really nice run, but if the kind of time horizon holds, share prices should be supported for at least another year, I think. So shifting gears, I wanted to talk about what some of the drivers of this semiconductor demand is. And of course, the big poster child for this rally has been NVIDIA, and they make AI chips. And so I think that, AI is going to really improve the productivity of corporations. And, in terms of GDP growth components, you know, the population growth is one, but also productivity. And I do think that the productivity gains that we're going to see from AI, generative AI, um, will actually move the needle on GDP growth, in my opinion. I mean, when every company starts, doing data analysis and, you know, getting more insight and, replacing, some mundane work with AI, I think it will help the overall economy. The other big driver is not new, but it's a very steady driver of growth in chips, and it's the chip content in cars. And back in 2020, as you can see in the graphic, 18% of the total car cost was semiconductors, but now it's 40%, and that's going to continue to go up, to be 45% as EVs um, have a different drivetrain. Instead of an internal combustion engine, they use a motor, and you need a lot of inverters for which are made with chips, inverter chips that drive the drivetrain. And then this isn't even including autonomous driving. If autonomous takes off, this percentage will go up again. So the content growth, although, cars produced is not growing that fast, the semiconductor content in those cars is leading to high growth of semiconductor um, chips that go into these EVs. So therefore, we expect the semiconductor industry will grow at least two times global GDP growth rate. It has, and we expect it to continue to. The other sector like I wanted to talk about is NVIDIA specifically because it's been such I guess, focal point, and the share price obviously has done very well, and we've been, it's been one of our top weights since we've started the fund. But the key point to remember is why, NVIDIA is taking off. Now, I talked about Moore's Law a little bit earlier, but we're running into limits of Moore's Law because we're getting down to like the physical limitations of, an atom. And, an electron has to be able to rotate around an atom to produce electricity. And we're getting to these kind of, you know, um, nanometer type sizes that, it's going to be harder and harder and more expensive to shrink transistors, right? So what what the industry decided is that, okay, well, we still need more computing power, right? Especially when we train these AI models. So they looked at their CPUs, and CPUs, they process data in serial form, so zeros and ones all in one straight line, right? What NVIDIA did back 20 years ago was they invented the gaming chip for video games. And when you're playing a video game, what you want is a smooth video, right? You press a console button, instant reaction, and you want a smooth video. But all the signal has to go to each pixel that make up the computer display all at the same time, right? So NVIDIA invented these game graphic chips that use parallel processing. So sending, you know, um, instructions all at once in thousands of cores instead of one, serial line of zeros and ones. That was great for video games, but then, the industry thought, okay, well, what else can we use it for? And then, of course, training, AI models came up and said, well, we could train these AI models much faster using GPUs and not CPUs because we got to show them, millions of pictures of cats and millions of pictures of dogs and be, have the computer recognize that this is a cat and this is a dog. And, using GPUs would shrink the time from training an AI model from months to weeks, right? And like time is everything in this industry. So everyone started using GPUs, and that's why NVIDIA has become the primary beneficiary of this trend. They call them, AI chips, but it's effectively the GPU that they're using. And you can see on the bottom, AMD, the CEO of AMD, Lisa Su, is not a promotional person at all. A few months ago predicted that the model just for data center AI chips, which includes, networking and then the AI chips and in memory and everything, all of the chips combined will be a $400 billion market by 2027. And she's not a very promotional person. So there's the market will be huge for this, in my opinion. The other important theme in this industry is geopolitics. Obviously, there's global competition with the U.S. and China, and you know, with Taiwan making the most advanced chips, and friction between China and Taiwan, the U.S. is trying to kind of diversify its production and reshore back some of the semiconductor manufacturing. They used to make 40% of global chips, and now it's down to 12, but they're trying to like increase it just in case there's tension in Asia. And so what they've done is introduce the CHIPS Act, which gives subsidies for companies to build fabs or fabrication facilities. And these fabs, there's a pipeline of announced, started, and pipeline projects of $200 billion, right? TSMC alone is building two fabs so far in the US, two fabs in Japan, the building one in Germany. And then, of course, there's others. And that's just TSMC, but the largest foundry out of Taiwan. But of course, as you know, China is building out their own semiconductor supply chain, right? And they're actually spending the most. So, Japan's trying to rebuild, Germany's trying to rebuild, and as each region, realizes that chips are just so, important strategically for the countries. This has been a huge benefit for our companies that we're investing in the semiconductor capital equipment, and the companies that supply the equipment to make the chips. Because every country is trying to build out their own supply chain. So that's been a huge benefit for us. The other, I guess, theme I wanted to talk about is how complex semiconductor manufacturing is. Everything, it's probably one of the most difficult things to do. And from design to the materials to the equipment to the process to the packaging, it's very, very complex. And there's, thousands of companies and there's thousands of steps that need to take place to build just one chip. And I gave you an example about, how NVIDIA is part of this. And, their chip design capability is one of the reasons why we're invested in that company. We like companies that have high intellectual property that other companies can't, mimic, right? And another company I wanted to explain was a company called ASML. They make this EUV machine. EUV stands for extreme ultraviolet, and that's a 13.5 nanometer light wave frequency. And you know, you need that that higher frequency of light to make these small kind of 5 nanometer chips, right? And so, but the way you produce the light source, and what they do is lithography, which is a light source that embeds the chip design onto the wafer. But to make this light source, what they do is they take a tiny droplet of tin, which is 25 micron in size. So it's a tiny piece of tin, and it drops 80 meters per second, right? And they zap it once with a laser, right, to kind of flatten it out. And then they zap it again, the same tin droplet, and then it turns into a plasma gas. And that plasma gas is what creates the 13.5 nanometer light source. And so the precision that they need to do this and they do this 50,000 times a second without fail. And so I'm trying to explain how complex that is. And there's two other Japanese companies that are big in lithography called Canon and Nikon, and they used to have higher market share than ASML. ASML now is 90% market share in all of lithography, but they have a 100% market share in EUV, right? Because the Japanese gave up and they said, "Oh, this is too difficult. We can't do this." So we like those types of companies, like NVIDIA and ASML, that can do something that can't be mimicked. And the table on the right shows TSMC's um, roadmap for their process nodes. And there's only three companies in the world that can make chips that are 5 nanometers, 3 nanometers, 2 nanometers, and there's a roadmap of 1.4 and et cetera. They're going to keep pushing that envelope, but there's only three companies. But TSMC of the three is by far the best. And so for these advanced nodes that are 7 nanometers and smaller, TSMC has over 90% market share. Samsung is having yield issues. Intel's just trying to catch up. So, TSMC is another company that we're invested in that has a moat around its business, and it comes around, and that comes from experience. Like, they have over 20 years of know-how. They were the first foundry, so they invented the foundry model, which is outsourcing manufacturing, and they've got the most experience, and that's why they're the best at it. It's a very difficult thing to do. I like to compare like ASML and TSMC. You need both, right? Like TSMC, you can consider it to be like the best chef in the world, and ASML making like the best oven in the world. That's kind of like the comparison, but you need both. And like I mentioned, Samsung has poor yields. There's these thousands of steps, so that you can't do like each step 99%, because if each step is done 99% correctly, at the end at the end of the whole process, you'll only have like a few good die, right? That it, that From the whole wafer. So you need near 100% accuracy and precision for all of these steps, and that's why TSMC has the best yields, and yields correlate directly with costs, and the profit that you can make with the revenues. So we like these types of companies. Shifting gears a little bit, I wanted to talk a little bit about more of the near term. So last year was a tough year. You could see the table on the left. We had a very rough. I'm sorry. The red line on the left is the year-over-year growth rate of the industry, and we had a very rough 2023. We had weakness in PCs and smartphones, and as I said, before, the industry was down 8.4%. Um, and with the with and on the right, you see the typical kind of growth. The reason why the chip industry tends to have more volatile growth than the typical industry. It's because in boom times, companies tend to increase their inventories, and then in bad times they try to deplete their inventories, right? So, in the industry, we call this an inventory correction or an inventory adjustment, and that's why you get these swings in revenue growth, as you can see on the left. And typically, what happens is that a downturn in the semiconductor industry is caused by a macro recession. But this time we had the pandemic, so it was very different this time. We had initially everything weakening, but then we had PCs and smartphones demand increasing as people were working from home or studying from home, or playing games on their smartphones from home. So we had huge demand for those devices, And then after everyone refreshed their devices, we had a very weak 2022 and a weak 2023. And on the other hand, the auto chips and industrial chips, like for factories, they had a weak, we had lockdown, so no one was driving, no one was going to the factories, so we had very weak demand for industrial chips and automotive chips. But then, when we had reopening, because production stopped in those semiconductor fabs, and it takes about 3 to 6 months to make one chip. You can't just restart the fab and like get back to normal. So we had a shortage, especially in automobiles. We had a shortage in automobile chips, which led to very strong growth. Unlike the PCs and smartphones, we had strong growth in industrial and automotive in 22 and 23. So very different demand cycles this time. And so right now, um, the PC and smartphone inventories are bottoming, and we should grow in 2024. But in automobiles and industrials, we have high inventories, and that should, lead to a correction. So, those are kind of like the different positives and negatives by end market. And you could see here, this is the industrial and automotive. The chart here shows the distribution channel days of inventory, and you could see it's at an all-time high. Um, and the reason why this is applicable to industrials and automotive is because most of the PCs and smartphone chips are sold direct. Um, the distribution channel is used mainly for industrials and some auto. And what was really weak was in the distribution channel in China was very, very weak. So we have to kind of work down these inventories for industrial and automotive. And on the other hand, the PCs, you could see the forecast for the PC market and the smartphone market from Canalys, and they're forecasting this year and next year to be up years. And this is actually before AI smartphones and AI PCs came onto the scene. So we should have actually a better 2025 than shown here. But as you can see, we've had a different dynamics in demand depending on the end market. One other sector I wanted to talk about was memory. These companies are like Samsung and SK Hynix and Micron. They make DRAM chips and NAND chips. And what is going on right now is there's this new DRAM called HBM, high bandwidth memory. And these chips are used with NVIDIA's AI chips because, to pass the AI, when you're training an AI model, you need really you need faster memory, faster DRAM to keep up with the NVIDIA's AI chip. And so they have this faster memory called HBM. And my point here is that this is the reason why we're invested in Micron and have a high weight in Micron. You can see in the gray box that the Micron CEO in their recent earnings call said that we continue to expect HBM bit share to be the same as our overall DRAM bit share sometime in calendar 2025. Now and you can see on the table on the left, Micron has overall DRAM market share of about 20 to 25%. And it's the light gray line. And with Samsung being the light blue line and Hynix being the dark blue line. And so Micron is going to go from zero HBM because they were late to this market, with SK Hynix having most of the HBM market, and they're going to have 20 to 25% market share. And that's going to lead to huge gains in revenues and gross profit, in our opinion. What I circled on the bottom was their gross margin percentage. During the last peak cycle, they had a gross margin peak of about 58%. And the consensus for 2026 is still pretty low, much lower than um, we expect it to be because HBM is a higher priced product and it's a higher margin product. So, we think that the street is underestimating the profitability for Micron. Now, moving on, I wanted to talk about a couple of risks, and there are three, in my opinion, that are very important risks that we need to consider before investing in semiconductors. One is electricity supply. These data centers that are getting bigger and bigger that run these AI models, training and inference, and we're starting to run out of electricity. Some states like Virginia have actually had to choose supplying electricity to the citizens or supplying electricity to the data centers. It's gotten that bad. And so this is a big problem. Now, the utilities, electric utilities are, doing something about it. They're investing in transformers and greenfield projects. But, you know, if they don't invest enough, this could be a huge problem. So what the hyperscalers, the data centers like Amazon and Microsoft and Google, what they're doing is they're starting to build data centers where there's energy. For example, Texas has a lot of energy, and the population density isn't so high, right? And it's a big country, so the population density isn't that high. So actually choosing states to build data centers where there is that enough energy and electricity. And the other thing is Amazon I guess a couple months ago, they announced that they were going to um, build their data center next to an old nuclear plant that they're going to refurbish and restart. And so they don't have to depend on the grid, right? They're just going to connect directly to the nuclear facility. And there's also some like these small modular reactors that produce nuclear energy. You could fit it on a these small reactors, onto a lorry, and it's very safe. If there's an accident, it shuts down. I think small modular reactors, you know, um, per data center, I think will be like the future, and that's really important because nuclear does not emit any CO2 emissions. So I'm a big proponent that data centers use more nuclear energy. Another risk is actually China, because the U.S. has kind of restricted China's access to, the leading edge equipment. So they're not able to make, 5 nanometer, 3 nanometer, 2 nanometer chips, but there's no restrictions for like larger transistors, right? And China has this, national strategy to dominate the EV market. And actually, they've done a great job, and they are dominant in that EVs now. And they also want to be dominant in chips that go into EVs, right? So they've gone all in on the mature node because you don't need like the small transistors because, a car is big. And so the chip can be big and you can use older technology. You can use mature technology, lagging edge technology to make these analog and microcontroller chips, right? That and so but the problem is, when there's a slowdown in the China EV market, and we're seeing it slow down already, but in 5 years, there's going to be excess capacity. And so what China's going to try and do is, export that excess EV capacity and the EV chips that go into them, into the Western markets. And so, this is another risk. And this is one of the reasons why we're actually underweight analog um, chips and microcontroller chips, because we do see, I mean, it's not going to make an impact short term because these life cycles, product life cycles are very long for cars and industrial equipment. But at the very least in 5 years, right, it's going to put pricing pressure even on the US and Western Western European and Japanese competition. So we're underweight this area. Another risk is actually we need to see generative AI applications like this earning season that just passed. The semiconductors had a great earning season, and share prices reacted very nicely. But software companies had a poor earning season. I mean, because they were like, kind of talking up AI for their own business, but they haven't seen it yet. It's going to take time for corporations to adopt AI, AI in software, right? Um, so, this is the third risk is that if we build all of this out, build out the AI infrastructure, buy all these NVIDIA chips, but like corporations don't use them, or say, well, I don't want to lay off people, so I'm going to not use AI, like that's a risk, right? So that's the third risk you should remember. Now, I don't think that's going to happen because I do think that corporations will use it. And there's one industry that's already using it quite extensively, and that's in content creation. There's a company called Adobe that makes, um, Premiere Pro and Photoshop and Illustrator. You may have heard of those softwares, but they've embedded generative AI into their products. And now content creators that create marketing programs and ad programs for, these brand companies, they've been, the creators have become so much more productive. Like generative autofill, right? It would have taken hours to kind of take something out of the background, but all they do now is type it in a prompt, and then it just does it automatically, and it saved them a lot of time. And so this type of productivity, I think, when one company does it, everyone will have to do it to keep up. So I'm very, very positive on corporations using AI, as well as AI that's going to be included in Apple's next operating system, the AI assistant in iPhone, 16 and 17. I think that'll be another big driver for a use case for AI. So I am confident that the use cases of generative AI will develop, but that's a risk if it doesn't. Okay, so moving on to valuation. This is the I guess a valuation table for the Nasdaq Global Semiconductor Index, which is the benchmark for this fund. I mean, you can see right now it's high. For this year, it's 30.63 times, which is high. But we just, in the first year of of the industry rebound, like, so earnings are still at a low level, right? Um, so that's why, 2023 and 2024 have high P/E ratios, which is the first line on this table. But if you go out, to 2026, where you're in now the third year of the recovery, and you're getting operating leverage, from the revenues growing, the P ratio is 19.09, and 19 times P ratio is not that high. It's about average for this index. So I know the share prices have done well, and the share prices tend to do well, in the first year of a recovery for semiconductors. So it's not surprising that the share prices have done well, but it's still the first year. And, I sometimes get a question about, is it a bubble? I was working in New York, during the dot-com bubble in the late 90s. And compared to that, this is not a bubble, right? Like it's being driven by earnings, right? Back in the dot-com bubble, there were no earnings. It was all just press release and a share price doubling because the company put .com to their name or something, or announced an e-commerce, strategy or something. But right this time, it's being driven by earnings, and that's why the P ratio isn't up that much. The earnings have kept up, especially companies like NVIDIA have seen a dramatic increase in their earnings. So the valuation is not crazy like it was back in dot-com bubble. It's actually very reasonable, in my opinion. And if you compare it to the S&P 500, the 19-point times, it's roughly the same as the S&P 500. So you're getting much better growth, with semiconductor companies than the S&P 500, and it's trading at a very similar P ratio. So I would think I still find it attractive, this industry. Um, this chart is a price chart of our benchmark, the Nasdaq Global Semiconductor Index. That's the white line, over the past 10 years, indexed to 100. And the orange line is the MSCI ACWI, All Country World Index chart. And this ACWI index is like the typical kind of benchmark used for global equities, like your traditional core fund. As you can see, it's a lot less volatile, right? But it hasn't performed as well as the semiconductor index. So, that's my main point here is that yes, if you invest in semiconductors, you have to expect more volatility, right? As I showed you, the inventories and orders, that tends to swing back and forth, which makes the earnings swing back and forth, which lead to like volatile share prices, as you can see. But if you look over the long term, the semiconductors have outperformed the equity index by a lot. And I expect this to continue, going forward 10, 20, 30 years, 4-year retirement, um, you know, of course, the global equity should be, kind of your core allocation, but putting like 10, 20% into more growth assets, um, you know, um, you'll, over like, until you retire, you still have 20, 30 years. So you'll add to that savings pot at the end if you do have better performance. So I do think having, kind of 20, 25% of your allocation to the higher growth would be my recommendation. And, you know, uh, I get a lot of, questions about timing, but, what I've been telling investors is, you should do dollar cost averaging. So every month, just you know, you know, set an X amount of money that you can invest, right? That you can save, put 70% of that in, let's say, a global equity fund, and then 30% of that in semiconductor fund or another high growth fund, and just do that. And if the share prices go down, you'll buy more shares. If the shares go up, you'll buy less shares, but you get a good average price, right? And when you're investing for the next 20, 30 years, that lower average price will be very key to getting a good return. So moving on specifically now to like our fund, you can see in this graphic here, our investment process. And we start from the benchmark that I was explaining, the NASDAQ Global Semiconductor Index. Now we can only choose from the 80 components of that index, right? That's kind of like a risk mitigation, to control risk that, we're not taking too much risk. So we have to select from that index. So, that index itself has their own, conditions of inclusion. And so, 80 companies are pretty blue chip in there, or, to start with. And then what we do is we screen out non-Sharia compliant companies. That's what, our portfolio managers and KL do. I don't do that, but, we screen out, the non-Sharia compliant companies. And then, we do our fundamental analysis and valuation analysis, and we have proprietary DCF model that we use here, at London and KL for our target prices. And then we construct the fund. We try to keep it, high concentration. We're trying to take risk, and actively manage this. So we keep the number of companies between 20 and 30. Right now, there's only 23 companies in the fund, so pretty concentrated. And some other restrictions, no single company can be over an 10% weight at the time of purchase. And this is not, our rule. It's actually Malaysian mutual fund rule that it can't be over 10% at the time of purchase. But that great, that acts as a great risk mitigation, and I'm all for that. And also, no single company can be plus minus 5% of the benchmark weight. Also, to mitigate risk. So this is on Bloomberg. If any of you have access to Bloomberg, you can see you could follow our NAV on a daily basis. It's right here, and you see the code for the U.S. share class here, and there's a Malaysian share class. But yeah, you could follow the performance and daily NAV movement with this code that I show on the screen here. And also this chart on the top is the actual NAV since inception. So we launched the fund, the roadshow started on 25th of July, 2022. But the first time that, the cash settled and we actually bought was the 15th of August. And that's why on Bloomberg, you only see the NAV start from 15th of August, is because that's the first day that we actually invested. And since that day, the NAV has returned 106.4%. The benchmark, the Nasdaq Global Semiconductor Indexes has returned 96.7. So we've had very good absolute performance and also very good relative performance. So our shareholders have been very happy. And below that is what I follow. The KL office measures performance for me on a day-to-day basis, and I use this. And before fees, it's doing even better, because the KL performance team shows the performance before fees. So some more, kind of fun information in terms of some of our overweights and our underweights. On the right, on the left are our overweights, on the left are our underweights, and I won't go into it. I did talk a little bit about some of these in my presentation. But in general, we're overweight HPC, high performance computing companies, including AI companies, and that is because we like companies with the leading edge technology that acts as a competitive advantage, as I've been explaining, and also semiconductor capital equipment. These companies also have leading edge technologies, and we're underweight analog microcontrollers, partly because of kind of like the high inventory levels that I talked about, as well as maybe longer term risk for pricing due to China's excess capacity that's coming. Now, I wanted to talk a little bit about a similar strategy we have in Japan. Now, when we launched the fund back in 2022 in KL, we used this fund as a track record of performance. And I'm the analyst that recommends to the fund manager in Japan that manages this fund. And you can see the code on the Bloomberg code on the screen as well. But it's a very similar strategy. It's an actively managed semiconductor fund. So I don't know of any other kind of fund that has two actively managed semiconductor funds on the market. So this is to show that we do have a long-term track record of performance and experience managing these actively managed semiconductor funds. Another question I get asked when I do market in Malaysia is, how much of a drawdown, if let's say we enter a stock market correction, how much, I guess, can we expect to lose? And what I have here is a table going over some of the kind of past corrections in the market. And on average, right, just using this kind of data set, there's been a drawdown of 18.6%. So if we do have a correction, and we can have a correction at any time, and of course, a bigger correction also when we do have a slowdown and a downturn in the market. But the average correction is 18.6%. So you should be ready. You should be ready for that. Um, and as a matter of fact, and the chart on the bottom here shows the fund, the KL fund that we launched, right? We weren't trying to time, the launch at all. But it was during the downturn. It was just before the downturn. And when we were launching the fund, I also went to KL, explained to a lot of distributors that, we're about to enter a downturn. We're about to enter an inventory correction, inventory adjustment phase. And so, um, you know, don't expect the market to go up immediately, right? As you know, 2023 was a very weak, 2022 was a very tough year for the market. And you could see, right off the bat, we lost 20%. So, I mean, it was very painful in the very beginning, the NAV going down 20%. But as you can see, like now, you don't even notice it, or, that it just looks like a blip on a screen, really, right? So my point to distributors is that, we did have a very painful correction already since launch, and it's only been a little less than 2 years, right? So, but over the longer term, you know, um, um, you should still, if you hold on, right, and you don't panic, you should, and if you hold on, you should have a very good return, in my opinion, over the next, over a 10, 20, 30-year type time horizon. And this is some more performance information about the Malaysian share class and the USD share class from Refinitiv Lipper. This is some more information from Refinitiv Lipper that we took that shows country allocation and our top 5 holdings on an absolute level as of May. And this is some of the fund details in terms of minimum additional investments, minimum additional investments, management fees, and so forth. And that's all I had for you. So I will stop here, and I will stop sharing my screen so that we can take questions if you'd like.
Okay, thank you, Mr. Kawamoto, for your insightful presentation. We are now open the floor for our Q&A sessions. Uh, so the first question, what are some of the risks that we need to aware when we investing in semiconductor industry?
Can you repeat that again?
What are the risks that we need to aware when we investing in semiconductor industry?
Yeah. Well, I went through 3 of them. Electricity shortage, Chinese excess capacity, and actual AI use cases coming. But I guess the question is more short term, I guess. And it would be if the semiconductor industry went into a downturn, right? Now, I did show in a slide that based on past, kind of history, 40 months from peak to peak. So, I mean, we shouldn't have a downturn, but it would be if, let's say, we had, a war breakout and, demand, we went into a global recession, that could cause a downturn, for sure. But I mean, like, I don't see that big of risk because, last year was a very bad year for, for the market, for the industry, down 8%. So, we're just in this kind of recovery phase. And, PCs and smartphones just recovering. And as a matter of fact, um, this year, automotive and industrial is pretty weak, right? So automobile and industrial will recover next year, you know? We've got a lot of factors where there's recovery, um, and so I don't think there's, a high risk of, the semiconductor industry entering a downturn. But apart from like the longer term risks that I mentioned, the shorter term would be, kind of a recession of some sort, downturn in the macro. Um, I guess another risk could be, if let's say inflation stays stubbornly high, and interest rates, don't come down, because like this, the tech stocks in general had a very weak time when the U.S. Federal Reserve was increasing interest rates from 0 to 5%, right? So higher interest rates are bad for tech stocks in general. Um, but I think, the good news here is that, you know, yes, the market did correct for a little bit when there was kind of stubborn CPI inflation, inflation data in the US. Um, and so like the number of Fed funds cuts, you know, got pushed out, and it went from three Fed fund rate cuts to one for this year. And but as long as like the next move is not up, I think inflation and interest rates should not be much of a headwind either.
Okay. The second question is we got a lot of similar question here. So how does the Nomura Semiconductor funds compare with the semiconductor ETF like SMH, as they are seeing the ETF annual fee are much more lesser? So what's make this fund an attractive investment option?
Yeah, the SMH has is actually has 25% in Nvidia, right? And like, don't get me wrong, I like Nvidia, but I think that's too much, right? Now they have this rule, SMH, they rebalance every quarter, right? So the ETF will come down. And so there's a maximum weight for one company of 20%. So Nvidia probably today, if you look at it, is down to like, 18% or whatever. I mean, and we don't do that. We don't sell because of rebalancing and stuff. And so, um, but that's one difference that I don't want to, talk badly about it, for investors, in SMH, that's another option for sure. But that, the 20%, versus our 10%, we take less, one company risk, in my opinion. And the other reason is really, you know, um, performance. I mean, luckily, I was showing you the performance. Before fees, we were outperforming since inception by 17 percentage points, which is huge. And we've done that, through some of our investment philosophy of just, investing, a concentrated, 23 stock portfolio of, companies that can't be replicated, right? And we've had like high weights and TSMC, Nvidia, ASML, Broadcom, these types of companies, Micron, and just concentrating our funds efficiently into those, because there are some bad companies, and I mean, like for example, we're underweight Intel a lot, and Intel's done very poorly, right? They had this kind of like honeymoon period where, they said we're going to do five nodes in 4 years. Trying to catch up to TSMC in terms of manufacturing and a process capability, and they caught up. It looks like they're going to be able to, to achieve that, right? But now comes the hard part. They're trying to to have a foundry business model, right? While also competing as a chip company. And they haven't really signed up too many foundry customers yet. So, I doubt that they're going to be able to make money in that business for a while. But if you look at the ETFs, they'll have like, 3, 4, 5% of Intel. You know what I mean? And there's a few companies, other, I won't get into like Wolfspeed, that have, silicon carbide substrates, a poor execution and stuff. So in these ETFs, you have the good and the bad, right? And we're trying to, at least in theory, we're trying to um, you know, not invest in bad companies. That's, I guess, how I'll answer that question. Yeah.
Thank you. Okay, the next question is majority of the holdings of the funds is in the US, which is around 61%. Is de-dollarization is a concern, and what will be the impact of the US interest rate reduction? Is the growing company may be affected?
Yeah. Well, in terms of 61%, I mean, to be honest, the benchmark also is very high, right? So, uh, manufacturing is done basically in Taiwan, but the leading kind of design companies, NVIDIA, AMD, right? Qualcomm, they're American and they're very big and they're very powerful, right? And so so uh, the index and just I would say that just the industry is very American, um, I guess skewed, if you will. Um, that like there are not that many chip. Like I mentioned that we can only select from the index, right, as one of the risk mitigation to I guess techniques. But like for example, we're not invested in many Chinese companies. Like for example, SMIC is doing a pretty decent job at the foundry business, but they're not in the index because they're sanctioned by the U.S. government. Um, so we don't have any Chinese companies at the moment. We may in the future, but right now, we do like to invest in the leading edge technology. So, the leading edge technology, which we consider to be like, the intellectual property that creates the moat, like the Warren Buffett moat. That's mostly U.S. or Japanese um, or or um, or Dutch companies, right? So the Japanese, we have four companies that are Japanese in there, and the Japanese are second in terms of semiconductor capital equipment. If the Japanese were not there, you wouldn't be able to make a chip because they provide a lot of the very leading edge equipment. And of course, the company that I talked about, ASML, is Dutch, and we have two Dutch companies. We have a German company, and so we have a mix. It's concentrated. We do have a mix of European, Japanese, but yes, most of them are American. In terms of what would happen if like interest rates did come down, um, well, as I explained a little bit earlier, the tech stocks did really poorly in 2022 when interest rates were going up. Um, because when interest rates go up, especially long-term interest rates, the discount rate that's applied to growth companies. In other words, earnings in the future, they get discounted back into the present value. And that's how the market works. The free cash flows of the future get discounted back. So if you're a high growth company and your discount rate just went up by 1 or 2%, that really hits your valuation, right? So that's why the growth companies, right, not just semiconductors, but all of tech got hit hard in 2022. And then when the market, realized that, okay, we're nearing the, peak of inflation, nearing the peak of interest rate hikes, then we've bottomed and had a good 2023. So if interest rates come down this year, like I think there's like the forecast is for one cut in Q4, I think is the consensus. If that happens, then that should be positive for tech. I mean, as I mentioned, it's really long-term interest rates that are important, not short-term, because the discount rate used for valuation, equity valuation, is long-term interest rates. So as long as interest rate, if short-term interest rates come up, the yield curve is a little bit inverted. If short-term interest rates come down, let's say next year a couple times, and the yield curve, you know, um, becomes normal, and long-term interest rates come down along with short-term interest rates, that should be positive, not negative for the tech stocks, including semiconductor. Oh, Harriet, you're on mute.
Okay, the next question is, how would we expect at the end of 2024 and in first quarter of 2025? Is the semiconductor sector expected to go to bullish, or will there be any correction or pullback?
Yeah, based on kind of like the analysis I did, of course, I mean, from week to week, there could be headlines about Ukraine or Israel. I mean, and of course, Biden versus Trump, and CPI this month, next month, uh, 2 months from now, CPI and economic data. I mean, you could of course have like, swings in share prices, but according to the data that I presented to you today, so a big correction should not happen, fingers crossed, but should not happen until like second half of 2025. And to be honest, I mean, that was, you know, this cycle is different because, the past cycles that I showed you, which were very close to 40, the period before that was 39, and then period before that was 42. I mean, there is a rhythm to these kind of inventory gyrations, So it is kind of the 40-month average, I think um is relevant. But the big difference this time versus the past, 3 or 4 times is that, we have NVIDIA, right? This AI chip market, which has just developed, right? And it's largely incremental. Some of it, as I explained, is taking some share away from CPUs like Intel, but most of it is incremental, right? If you see some of these data center companies, they're increasing CapEx by a lot, but they're also seeing a lot of revenues coming from AI training and AI inferencing. So the whole industry has kind of like this whole added like a whole new market. So when you consider that, this cycle should last longer than the past, right? Um, so it should last longer, but at the very very least, the cycle should last at least until second half of 2025. So over a year, I would say. And then, when you looked at the other chart that I showed about, how the share price correlates, hopefully I was able to show you that the correlation is pretty high with those kind of peaks in unit sales of chips. And so share prices should stay firm, right? It's hard to say for sure, and I can't make any promises, but they should stay, supported. I think for at least another year, in my opinion.
Okay, the next question is, how would the CHIPS Act in the US help to generate a real payoff for the chips making company like the Intel, TSMC, and Samsung?
Yeah, no, excellent question. The CHIPS Act has $39 billion just for manufacturing. And there's tax incentives, R&D tax credits and other stuff. a total like over $50 billion, but 39 billion just for manufacturing. And they've started to kind of, allocate some of the money. And TSMC and Intel have gotten their money, or at least, the process is underway. TSMC in Arizona should be getting, I believe, about $10 billion. I forget the exact figure. But this money is very important because, you know, um, the US, at least right now, is relatively small compared to Taiwan. So, and plus the wages are higher as well, right? And so, it will cost more money to make chips in the US. And so they're building two advanced fabs in the US. They may build a third one. But it's going to be a 4 nanometer fab and a 2 nanometer fab um, in Arizona. And now they're going to like with this $10 billion that they're going to get. Now with that, like the management has said that TSMC management has said that the profitability is now, with the subsidy from the CHIPS Act, will be similar to, kind of our Taiwan operations. So this CHIPS Act is very important. The other thing that TSMC said was that, we will price higher, right? If, we're doing the US a favor by building these fabs. Um, but if, we're like they're targeting an ROE of 25%, and their gross margin guidance is for, over 50%, uh, consolidated gross margin. So if they're not getting their gross margin, or if their ROE is low, they will charge higher. And obviously the U.S. companies are obliged to use TSMC. The country wants it, so they will raise prices. And so, um, but yeah, I mean, TSMC is a clear beneficiary of this, as well as is Intel. Some of the other companies that are getting money, Micron's getting money as well. So, yeah, there's a handful. There's a handful. It's mostly the advanced node, right? America wants the leading edge to come back. They don't want like, the lagging edge, that they want to have a differentiation, a competitive advantage to China. That's the leading edge. So they're incentivizing the company. Samsung's another one that's going to be getting money. So, yeah, to answer the question, it's going to be the leading edge um, companies that will benefit the most from the CHIPS Act subsidies, and specifically TSMC, Intel, Samsung, and Micron.
Thank you, Mr. Takeshi. So the next question is, what are the geopolitical risks associated with the coming US election as far as the semiconductor industry is concerned? What happens if US go into recession as some of the analysts has already warned?
Yeah, in terms of the U.S. election, I don't see much of a difference if it's Trump or Biden. Like I had thought, when Biden had come in, right, he would be a lot less hawkish on China. But in fact, I don't know. He's been just as, if not more, hawkish on China, right? He extended the China tariffs, right? And some of them were about to expire. And he extended those. Um, and probably if Trump gets in there, he won't, he won't ease up. He might even increase tariffs even more. Um, the one big difference is that, I don't know how exactly this is going to play out, but Biden's been better at building alliances again, and obviously, this restrictions on China would not work without the cooperation of Japan in ASML, because Japan and ASML combined, I think have not all of the equipment, but most of the equipment to be able to let China advance um, their dreams of more better technology. So if Trump gets in there and he starts talking about how he's going to walk away from NATO and all this, then yeah, then I think maybe I don't exactly know how they'll play out, but um, maybe that might be bad for or good for China and bad for the U.S. Maybe I'm not sure. In terms of the recession, yeah, no, I mentioned this a little bit before, but yeah, if there's a recession, some analysts, well, I would say the consensus right now is for a soft landing. Um, I have to admit, some of the retail sales data out of the U.S. last couple of months have been softer, admittedly so. But not really, that weak, right? The other is in China, also retail sales pretty slow, but actually better than expected, But yeah, I mean, there's not that many economists calling for a recession, I don't believe, in the US this year. But to your question, if we did have a recession, yeah, we would, yeah, the semiconductor stocks would go down. Yes.
Okay, we got another question here. So, what are the advantages of investing in semiconductor fund versus the high-tech software funds that includes the giants like Microsoft, Amazon, Meta, and etc.?
No, that's a great question. And I don't mean to, you know, um, you know, talk anyone out of those funds. Those are great companies too. But one thing I will say though is some of those funds, right? Um, like, well, like there's Kathy Wood's fund, like the ARK fund that's invested in ARK Innovation Fund. They're investing in a lot of software, right? Um, Companies and our fund has done a lot better since inception, a lot better. And so um, and I think there's also been a couple of other competitors in Malaysia that have that we've been competing with, since inception. We've beaten those as well. So software is an interesting place to invest in, but as I was mentioning a little bit earlier, they haven't seen the AI benefits as much as semiconductors so far. So that's one of the reasons. But the other thing is that you know when you look at some of these tech funds, right? It's not all tech, right? Like a lot of these tech funds tend to invest in like consumer discretionary or companies that use tech, right? Companies that use AI, right? And they're not they're not necessarily technology. So you know, so I would say like with our fund, you know what you're getting, right? For good or for bad, you're just getting pure semiconductors, right? And so um it's a pure tech fund, whereas I don't know, some of the others um may not be, right? I mean, they might be invested in some of the kind of Mag 7, but when you look at the rest, when you look at the rest of the portfolio, and I may be completely wrong, but if you look at all, their entire portfolio, they probably have very good diversification, which is great, but you're not investing in tech. Um, yeah, I hope I answered the question.
So will the SMCI, the super micro computer, that making the cooling for the chips will consider as part of the chip funds?
No, it's they are in hardware, so they are making the AI servers. They're like a they are similar to like a Dell or an HP that make that buy the NVIDIA chips, right? And then add the cooling and then sell the box to a customer. And of course, there's engineering and all that services that go along with it. Um, but no, this fund, as I mentioned, can only buy from the 80 companies that make up the benchmark, which is the NASDAQ Global Semiconductor Index. And since Supermicro is not a semiconductor company, we cannot buy it. That said, um, I don't think, even if I could, I don't think I personally, like, I'm not an expert on the company, but I don't think I would buy Supermicro. I mean, I think, NVIDIA going up, 100, 200% share price, makes sense. They have the best chips. They're adding the most value, right? What is Supermicro adding value? They're buying the NVIDIA chip and they're just plugging it into their server, right? The value added and in the share price appreciation should go to NVIDIA more than Supermicro, in my opinion, right? And so liquid cooling, yeah, I mean, they may have a good solution, but there are competitors there. There's Vertiv and Delta Electronics, Light-On, that do liquid cooling. I don't know how um as I said, I don't know the company great, so I don't know what the differentiation is between their liquid cooling versus like a Dell or a Delta Electronics but you know, I mean, which is the better company to invest in? It's got to be Nvidia over Supermicro, in my opinion.
Okay, I think that's all for our Q&A session. So once again, we thank you very much, Mr. Kawamoto, for joining us today and giving us such insightful presentations. So, are you going to share about the promotional campaign that I have mentioned earlier? Okay.
Thank you everyone for joining.
Thank you. So for the promotional campaign that I've mentioned earlier, registered attendees who attends this webinar will receive a 0.8% promotional sales charge campaign code to invest in Nomura Global Sharia Semiconductor Equity Fund in NYR and Nomura Global Sharia Semiconductor Equity Fund in USD from 24 June to 28 June. So this campaign code will be sent later by tonight to the email that you have registered. The first 30 webinar attendees who utilize the campaign code to invest a minimum 1,000 ringgit in Nomura semiconductor funds and or USD 1,000 in Nomura semiconductor in USD in a single transaction within the campaign period will receive a 30 ringgit Touch and Go e-wallet reward reload pins. So we have another campaign going on where you will receive another 10 ringgit bonus unit for every 1,000 ringgit invested in technology and semiconductor unit trust funds. So for more terms and conditions, feel free to visit our official website in FSM1 on this topic. And later then you will also receive an email which will lead you to the link. Okay, so if you have any further question, feel free to send us an email at investhelp.my@fundsupermart.com. Link is in the chat box. A replay of tonight's session will be available right after this. So you may head over to our Facebook page to catch this replay. Okay, so thank you very much, Mr. Kawamoto, for joining us today. And thank you everyone for attending tonight's session.
Thank you
Thank
for
you.
joining, everybody. Good
Thank
night.
you. Good
Good
night.
evening.